Good morning. This is CRE360 Signal for Tuesday, October 28th, 2025. Today, a regulatory shock for multifamily pricing, capital sharpening its pencil for re-entry, and a new wave of office credit stress. First up, 4 state attorneys general, DC, Maryland, New Jersey, and Kentucky, are urging a federal judge to reject the roughly $141 to $142 million class settlement tied to alleged rent price fixing via RealPage. They argue the deal provides meager relief and could undermine their own enforcement. Here's the scope. 27 landlords have settled, including a $50 million payment from Greystar, about 35% of the total, while RealPage and others deny wrongdoing. The DC case is first on the docket in March 2027, which means a prolonged legal overhang. And the market reach is significant. Firms named in these suits manage about 12% of U.S. apartments and a striking 70% of units delivered since 2020. Translation: even incremental remedies could ripple through rent-setting practices. For operators, the takeaway is clear. Assume no algorithmic premium, tighten compliance, and stress test cash flows for flat or lower rents. Meanwhile, fundamentals are soft. Asking rents fell 0.3% in September to $1,712, the steepest September drop in over 15 years, with annual growth slowing to just 0.9%. Vacancies are around 6.5% to 7% as peak deliveries hit the market. Sunbelt tech hubs are under pressure. Austin down 4.4% year over year, while San Francisco and Chicago outperformed. Lenders are holding spreads wider, underwrite 0 to 2% rent growth and higher economic vacancy through 2026. On the capital side, institutions remain underallocated to real estate by about 9.8 percentage points, even as target allocations sit near 10.7%. 64% rate CRE6 or higher out of 10 for opportunity, and debt markets have reopened with Q2 originations up 66% year over year. Expect selective buying, lower leverage, core bias, and heavier diligence into late 2025 and 2026. And office delinquencies just notched another jump. CMBS 60-plus day delinquency at 8.12% for office in September, pushing overall CRE CMBS to 3.1%, the highest since 2018. Notable, a $180 million maturity default at 261 Fifth Avenue, and Hartford's City Place The Fart at $79 million. Underwrite multi-year lease-ups, big TI and LC reserves, and refinance outcomes at 50 to 55% LTV. Practically, this is a disciplined market. For multifamily, favor retention and operating efficiency over rate push, model no algorithmic lift. For acquisitions, match capital's mood, 50 to 60% LTV, rate caps in place, DSCR above 1.30x on today's rents. If you're touching office, only do so with a conversion angle, municipal support, or a dominant leasing edge, and patient capital. This has been the Today's Signal. For charts and the full newsletter, visit CRE360.ai. Research-driven and built for operators. Have a wonderful day.